Thank you very much, Sean. Thank you very much, everyone. Welcome to another session of our weekly market analysis. I'm so pleased to have you. Uh, Last week when we spoke, we mainly concentrated again these big earnings coming up, and I think they did not disappoint us as far as the excitement. And what is going to happen, I think now that we got a good chunk of the major mega cap earnings out of the way, although we still have a few weeks, maybe a couple of weeks at least, and then everything starts dying down. We are gonna move back to the economy and what's gonna happen with the economy. I think for the next 2 months, that's starting with the next week, so we will talk about the events, upcoming events. I think the focus is gonna move from, again, more of what is happening with the earnings, going back to what is happening with the inflation, interest rates, supply chain, and interruptions. Obviously, the Fed, the politics in Washington. So it's all gonna start playing hands. So this week, we still gonna emphasize more on the markets. I decided to do something different this week on our trade of the week, which I will share with you. And then we have a short lessons of the week. So with that in mind, let's start with as always, with the big picture, the economy, where do we stand? And this is mainly for the United States. So as you can see, the continuation of the initial jobless claims drop is, obviously it's impressive. And when we look at the cumulative continuing jobless claims, month over month, week over week, we are hitting the best since the pandemic started, and even staffing index. And one of the things we hear a lot, that I was in a gathering yesterday. So since the whole thing with this vaccination and COVID kind of coming a back burner, of course, my wife, we get invited to a lot of parties, and I'm like, I was in some good ways, the COVID kind of helped me to focus on work, but not like every weekend we have to go to these extravagant parties. But it was interesting talking to some of the business owners, and every one of them, they're just talking about lack of labor and also supplies. How the shipping cost has gone to the roof. How some of these, even though if the cargo is out, sometimes the cargoes are lost because there's just so many of them. So, and how the customers are willing to pay whatever money is offered as far as ask. I mean, so basically it's amazing. So that's a key understanding that the Fed, I think, should pay attention is underneath what is happening with this inflationary pressure. I know soccer socks are being sold, the Nikes, at $35. Soccer balls, Nike soccer balls, are going from 70 to 140, and people are standing in line to buy those just from the soccer side of things. The shoes, the uniforms, it's just amazing because there is no supply. So people are willing, and they're willing to pay. Or you talk about prime, from prime beef to steaks. Things have gone expensive, but people still are willing to purchase that. On the other hand, the employment, the wage inflation still is with us. I mean, going from minimum wage to 15, you go to 20, but then that $20 is going to purchase similar to what it did a year or 2 years ago. So that's what we have to be careful. But again, it's good to see there's that improvement. As you know, we had the GDP when it came was softer than was expected, and main reason for that, the catalyst, it was told that was more of the Delta variant, what was happening, and that was something temporary. We shall see. So what we want to emphasize is what is coming up. Again, the big earnings came, and went, and there's some really good earnings coming this week, but the focus is going to go to what we're going to have on Wednesday. So the most focus will be on the FOMC and what they are going to talk about in the press conference. Main concern, of course, it's been like about the tapering, but also when they're going to increase the interest rates. So on one hand, the markets are looking at the ADP non-farm employment changes. They're looking at the Institute of the Supply Management, the Purchasing Management Index. They're looking at the signs of the activities in the economy. On one hand, they like the economy grow. On the other hand, the markets are funny. They look at, oh, if there's a slowdown, maybe Fed will say, well, we are not going to basically increase the rates till we know exactly where we stand. So this is, I think, it's important to understand. So Fed is going to play a role next week. And on top of that, we just talk about the private employment on Friday. We'll have the Canadian and the US at 5:30 West Coast time, Pacific time. You're going to see what's going to happen with non-farm employment changes and where the wages are. These two are pretty important because they give us a good indication of where we stand. So let's be aware of that. I think if you're going to do any trading, just be aware of that. One of the things that we have talked in the past is, again, based on my experience of trading on, let's say, the non-farm payroll, it's usually the high or low of the day. It's the stamp is done at that moment. So the markets usually have some volatile reaction, and based on, again, maybe 80-85% time, you shall notice, again, that's in the futures market, usually the high and low of an S&P is marked at that. So just a food for thought if you're going to do any trading, let's say once the market opened for the cash market. So let's go into dive into the markets. Now, as you know, we talk about the sentiment, because I think it's important, because it's the emotions which drive a lot of times the markets, although I know we have the computers and algorithms and all that they do, but we still have the emotions, especially from the retail side. So the reason I share these with you, so you can have, again, build a story about the human nature and the sentiment. And I shared with you, again, when we had like 4 weeks ago, we had a lot of people very scared. We had more than average in the bear camp, much less than average in the bull camp. And look what happened just in a matter of a week. And then now there are more people bullish and less people are bearish. And when we go to CNN Fear and Greed Index, not long ago, 3 or 4 weeks ago, we were at 25, 32. We are at 72 now. The same thing, actually, we've been pretty flat with the Citigroup. We had actually gone down. Now they're getting close, completely not euphoric, because I think this is when we go 1.5 or when we've been at 2. That's euphoria. Those are like really extremes. But again, this is the human emotions that they react in a way that when they have a few good days, they think everything is good. Obviously, we have the seasonality. We hear about the Christmas and the Christmas rally, the holiday rally, and the Thanksgiving is coming. I can't believe tomorrow is Halloween. Once Halloween is here, you see everything out there for Christmas. So granted, the spirit is there, especially compared to last year. People are really willing to go out. They're gonna spend money, hopefully, if they find the things that they want. So I think that's one of the reasons, but still, it's a big difference when you go just 3 or 4 weeks ago from 25 to 72. So by looking at the charts last week, basically our biggest winner was the technology. And we'll go and depth why it happened, and I'm sure you do, because I think this week I'm going to emphasize again more into the interrelationship of our different asset classes, because I think it's very important to understand how each one drives each other. And then you could see that Dow Jones Industrial was all relative to other big indexes was the smallest, and S&P was right in the middle as always. So this is, just want to show you this chart, like right around here, that's what we had, the fear. And here we have close to the greed. So just the human emotion. And we were afraid, we're thinking the markets are going to go to, they're going to drop big time. There's a fear of, a big correction coming. And this was the reaction. So now we are all, everything is good. So the week that we had, there was a little mixed message in a way. We didn't really have big winner, except I believe the technology was the big winner. Obviously, for two main reasons, I would say. One was the earnings came, and the second one, when you think about Microsoft and Google, stellar earnings, and Apple, and then, but then like Amazon had its own issue, because Amazon, I don't know what it is. It's like, it's everything from space to retail to technology. I mean that. So, but the other thing was the interest rates. So those two went very nicely hand in hand. So, but you can see the defensive side, the utilities were actually down, and we really didn't have, again, big winners. S&P was up 1, and then small caps, they were very flat. So the advanced decline line was 18 to 16. So in a sense, it was pretty neutral. One thing is, we can see the dollar was a little up, especially on Friday, and that really saved it. But the bonds also, they were up, and we will look at some technical reasons, but I'm going to go more in depth, and we look at the charts, what is happening with bonds and why is that happening, and what indication it provides. What does it indicate as far as the coming days and weeks? So, but the bond was up, so that meant interest rate went down. But our commodities, which is the crude oil and gold, they were pretty much flat. Gold was down a little bit. We will discuss our gold trade, and we will discuss the gold as a whole from the technical point of view. And consequently, look what happened to CRB index, the inflation index. We were absolute no movement. So, that in mind, let's start. I'm going to start with this chart of the S&P futures, and I think I'm going to spend a little time on this to see where we are standing right now. And again, this is end of October. We've talked about volatility of October, but as I mentioned before, here there's a lot of fear, and now we got a lot of greed. So what happened when we went back? The high of the all-time high that we had was and right before Labor Day. So when we did the Fibonacci from the high to the low of beginning of October, I did the extensions as well. So what we did last week, we talked about, it was amazing that we've had this almost 8 days of nonstop. Last Friday, we did have a pause. So we kind of rested. And the reason was we were against our, it was not even closing high, it was actually intraday high. And that's where we were resting. And then Monday, we went through that. And then Tuesday, we had a pause. And that was right before the earnings, the big earnings coming up from, so we had the Facebook here, but then we had Microsoft, Google, and then we had Thursday. So we've been holding that 100%. So naturally, it looks like an extension, the 127.2, which is 46.16 on the futures, which is only 14 points away, is a natural attraction. The concern I have is obviously because we've had these very under average volume. So we shall see. As I mentioned here, I felt what we had here was more of a short squeeze, and then the buyers came in, and we were, as I mentioned, that everything was about earnings for the last 2 weeks. So we had the financials, now we had the technology. The question is also technically, we talked about this bow tie, which is, you know, the moving average expanding. And the thing is, how far can they get separated? Because we've talked about, again, the children want to go to their parents. So the shortest moving average likes to go closer to the longest moving average. So we shall see about that. But as of now, we don't really have, and as we go to the next slide, really don't have a sell signal, or at least a short signal. You can lighten up. And what I have to tell you for this week, because of that FOMC, I think we'll discuss it when we talk about interest rates, I would, if you're going to do something, I think I would not do a swing play. I would watch, obviously we always watch the weekly and look at the daily, but I think the 60-minute chart would be a good, at least for this week, till we get something from the Fed, because the markets are giving us mixed messages right now, or they have a little confusion. So I would be more cautious for this week. I would play more short term, and I would definitely, I think you would get better guidelines from your 60-minute charts. So as you can see, we are embedded. The trend is still up on the MACD. We did go hit our Bollinger Band, and we came down on SBS cash. And then on a weekly basis, we are holding above the 18 weeks. We did go, and on a weekly basis, we're hitting our upper edge of Bollinger Band, and we are overbought right now. So we shall see what happens. So this on a stochastic tells us that we are overbought. As far as the NASDAQ, as you can see, again, because of the earnings, because of interest rate, so they're looking very healthy. We broke through that resistance, so there's an all-time high. We are embedded. The MACD is up, and it's the Russell, which has been really, I mean, we can just keep talking about this. This again, it could be a good. We've talked about RN condors, or you could do vertical spreads on this all day long. When it hits upper edge, let's do the call spread. It goes, you know, close to the support line. Let's do put spread, but it is overbought, so, and it's trending down. So we want to watch this because it was the weaker of all the indexes. When we look at the Dow Jones, it has been embedded. MACD is up. As far as the transportation, we talked about monkey bars and railroad tracks, and now this week we're pretty flat, and we are still embedded, so that's good news. But we're getting very close to being overbought, but that doesn't mean anything at this time. So still there's strength. We look at the VIX. So we had the class, which incidentally, we will have our second segment of the VIX. We're looking at this, so it looked good, but then we have this heavy resistance here. So if we can broke through this, then that gives us a good indication. So I think what we are looking at, again, looking at what is going to happen with the employment and the FOMC. So in that situation, and right now, technically, we are at the resistance, although we are oversold. So we have, this is not the time. Actually, might lighten up, but I won't short it yet because I want to see what's Monday gonna bring. If you're gonna see if the trend is gonna change, if you're gonna go above zero, and the direction of the trend. We are not an uptrend, obviously, because we are below the zero, but would the trend change? And then we look at the volatility of VIX. We had a nice day on Wednesday, and then now we reversed on Friday. But the momentum is in the neutral and moving up. So we shall see again the same thing with MACD. It's kind of flat. So that will tell us would that volatility come into the picture. This is the interesting things. As I mentioned, we look at the interest rates, and we've been moving up, higher high, higher lows, and then this is what happened. So we have broken below the 18-day moving average. The direction of stochastic is down, and the MACD is down. So now visually, by looking at this, I think it makes sense why the NASDAQ looked good and why they had this strength. So the question is, would this last? And again, what is the projection of, Paul has talked about tapering, are they going to be hawkish? Are they going to be dovish? So that's going to be interesting. I think the markets are looking at that. And when we look at the 10-year note, so it's the opposite. As you can see, though, the 10-year note is under its 18-day moving average. It's not, it's not definitely clear. It's below my support line as there is resistance. So again, this is all about, I believe, Wednesday and Thursday. I don't do trading much on Wednesday. I'd rather look at what happens the day after. So, but MACD, it's not a lot of conviction though. So I want to watch that. The longer term bond, the 30-year bond, has had a better movement. We are nicely above 18, but again, you see that resistance. So that 100-day moving average, we are overbought, although MACD is positive. So let's watch this with the double bottom here. So let's see what happens with that. So what I want to, I added another slide, because what was interesting last week, the last 3 days, is the heavy volume 3 days in a row. And I went back in the last 8-10 months, and anytime we've had, not the roll months, the days that you have 3 days of rolling and a lot of volume activity happens, but when there is not that related, there's a big volatility in stock market. So it's not the direction, but there's a big movement. So it is, again, what the bond market are telling us, that there is expectations, and is that heavy volume came in the last 3 days. So I'm watching that. While I see that the futures on S&P, they're kind of below average, but we can see how the bond has been very active. So that's very important. So you see, we looked at the opening up from point of view of the S&P. When we looked at the bow tie, and the moving averages are converging. Now I'm doing the opposite. I'm looking at the bow tie on the downside, but now the moving averages are converging. So I'm looking at what the S&P do from the top while the bonds are doing from the bottom. So this is important to see. We are above the 50-day moving average. And the next slide is going to be really interesting. The correlation, again, we look at XLF. So remember, we saw the NASDAQ moving up nicely, and then XLF, it's been pretty flat. It was down. We are right on the overbought. The MACD is thinking of crossing. So we had a red candle, green candle, red candle, Wednesday, Thursday, Friday. And when I go back to the, let's say 30-year bonds, green candle, red candle, green candle. So that's how the interest rates are affecting different sectors of the market. So that's what I really want to understand, the interrelationship of these assets. So, and again, there's going to be as far as the interest rates going down, well, that's not going to be good news for the financials. So that's what they're waiting. As far as the dollar has it's an interesting concept that usually when the interest rates are going down, the dollar will go down. But Friday we had both going up. There's what that tells me is there's a little nervousness. So the money has gone to the dollar, but we are in a very narrow range, and we also are right against the resistance. So this is also indecision to see what's going to happen, and we are overbought. With that in mind, then how is that affecting gold? Now, gold, well, we are above the 18-day moving average, but when we talk about the gold trade, for instance, we will discuss we've had this 100-day moving average. Look at this consolidation, this area. We've been above this narrowly, but we broke down on Friday. But we went to that 18-day moving average and we stopped. Visually, I see there's a little convergence. We are overbought and momentum is going down. But the trend is up, but it's income going down. So this also very much interest rate and FOMC related. So that's another connection. Now, when we move to silver, it has been stronger, but because again, the part of the economy attached to this, but if you did sell, and I think last week I mentioned that if you had done any vertical puts or you had sold puts on this might have been a good time. I think last week I said, lighten up. You don't have to short it, but maybe it will be a good time if you are doing covered calls or you do have the poor man covered call. It might be a good idea to maybe go to 26, or I mean, this is on silver. On SLV will be 24.5 or so, because there's big resistance here, and the momentum is down. As far as the copper had a beautiful ride, and again we got the different factors. We talked about gold, but as far as what's happening in China, and also we're looking at the infrastructure bill. So that's again, that was a big move, but we've talked about, and you can see how we cannot stay outside this Bollinger Band. We have to come, and once we lose our embeddedness, we like to go kiss the next support, which is usually 18 days. After that, we went to the 100 days, so that's where we hold in the support. As far as the Bitcoin, it has its own world now, and what's going on. There's just so much attention that every day there's a new channel. You go to the parties, you talk about average retail investor. That's the subject. That's getting Googled a lot, and people talk about alternative currencies. The sad part is, I ask people, there's like the Shibas or Dodgy Coin. Oh, they have invested. They have sleepless nights. Like doubled, tripled, and then it went down to half. And I say, do you even know what it is? No, but it's doing great. So that's the concern I have about alternative coins. But here's Bitcoin, and it's holding its support, and that 18-day and holding this support, which used to be resistance. Crude oil, it has had a really nice run. We are sitting at 18-day. We were overbought last week. We talked about that at losing our embeddedness, and MACD has crossed. So we want to watch this, especially the energy sector. So we'll see, but still, it's a bullish run, especially now the cold weather is coming. And but we want to watch this. Obviously, today we have the climate and the Glasgow conference. What's going on? So this weekend, so that's in the forefront, and with all the regulations and other things, and consequently, you see the XLE looks similar, sitting right on 18-day. The momentum is down. We already crossed the MACD, so we shall see what happens next week. If we break down, we're gonna go to the Bollinger Band. All right, continuing. This expected move, as you know, I'm a big believer, especially when you're playing options. It does not disappoint. A lot of times it gives us a really good picture of the expectations of the markets. And look what happened on Friday. We did have the all-time high close. But where did we close at? We closed it right at the upper edge. And last week, the expected move was the volatility has really crashed. It was at 54. This week, we have a little expansion. We're going to 64. So there's a little more volatility coming to the picture. Now, we talked about NASDAQ being the strongest. So the NASDAQ tried to hold for 2 days that upper edge of expected move. But then after the earnings from Apple and Amazon, and the day before from Microsoft. So what happened is we had to hit the all-time high. We broke above the previous highs. And now the Russell 2000 actually did go hit the lower edge of expected move and finished right in the middle. You could notice it was up like 0.2% or so. The Dow Jones right in the middle again, it was up 0.4%. But the bonds were so strong that they actually closed. This is the TLT, the ETF. They closed almost 2 standard deviation. They went above the expected move. Gold had a big drop on Friday, but came close to the lower edge of expected move, while silver did actually stop right at the lower edge of expected move. And then energy, this is a financial sector, right on the lower edge, stayed right in between 1 standard deviation. It worked. The same thing with the XLE, right in the middle. So they all have worked. A couple of things I added because Apple and Amazon, they came with their earnings on Thursday afternoon. And it was really interesting on Thursday during the day before the earnings, Apple actually had a nice day and went and stopped right at its expected move. And after the earnings, I think it was $4.50, $4.50 for the expected move for the Apple. And again, it just stayed within 1 standard deviation, no big surprises. And so if you played any earning play, you would have worked out really nicely. Amazon did the same thing. Amazon on Thursday actually went outside its expected move. But for the week, with the earnings and then, again, the big movements, it did not even touch its, lower edge of expected move. So that was interesting. Okay. Let's have some quick lessons. And one of the lessons is visit this. So every once in a while, I like to visit it. Where do we stand as far as the major bear market? So again, I'm emphasizing major, not just the bear market. And where we are right now, so we go back since 1950, we've had about 6 major bear markets. This has been the average for all 60 years, and we've been at 60% average whenever we have bear markets. After 400 days, that's where we are right now. 401 day is this blue line. We're already up 92 or 3%. And on the 400 day, while the average was like probably 52%. And the one that we had the financial crisis and the bull market from the the start of that from 2009, at this moment we were at 70%. We ended up at 85%, but at this moment, actually by end of that major rally that we are looking at for the next 100 days, after the 100 days, we are ahead of where we were 100 more days on the financial crisis. So it's been pretty strong. You can see this big gap. They were following each other, and then now, I mean, just flying. So just a food for thought where the Dow stands. So just thought to share like a little couple of tidbits as far as what does major bear market means. That means if you have correction of 30 or the sell-off of 30% or more. We've had 6 of them since 1950 to 2020, the last one being the pandemic bear market. And but when we talk about regular bear market, we're looking at 20% down And when we talk about correction, we usually talk about 10% or less. So these are the different differentiations. The biggest bear market actually with Dow, it happened from 2007 to 2009, and the Dow was down 53%. So just a little information about that. Now, during our, I will have this again this coming week in our class. I did talk about that while we talk about VIX all the time, which is interesting, it doesn't show this, but all of these, VIX is specifically for S&P 500. In previous chart that I had, there was a lot of things like this was written. For whatever reason, TradeStation could not provide me the information, but I didn't have the information on, like, let's say, emerging markets or on China or Brazil or the gold miners and the energy sector. I might not have the energy sector, but not on Goldman Sachs or Amazon. But it is available. So if you ever wanted to see how does the volatility works on each individual, so it's like the VIX of them, it's like a 30-day, right? So it shows what their volatility is. We have access to that. So to go a little further, I just thought, okay, look at Apple's, for instance. This is the 30-day, this is the VIX of Apple. You can see, you know, the earnings coming, we've had much more volatility. Look at it on a daily basis, like in May before it, July earnings coming up, we could see what happened. The volatility really moved up, then collapsed. This time we had some volatility before, but then we had already gone down. So, and then you can see on Friday, now that earning has come up, then the volatility really crushed. So why is it important to understand the volatility? So I want to share another chart that probably you use it anyway, but it's good to see visually because we look at the expected move, we look at the implied volatility in our option pane and the platforms, but on the chart, it's good to see because we always look at the averages, right, as a smoothing indicator. So this is as of Friday's close, right? So this is what the market's thinking as far as the implied volatility for Apple. And you can see, again, after earning, we went down, but compared to what it was pricing, let's say in August and where we were. So by looking at this, but also comparing it, this is the ratio of the implied volatility to historical volatility. So where implied volatility is going down, and then it goes really low compared to historical, then you know, again, the markets are the mean reversion. So if my implied volatility is actually less than past 52 weeks, for instance, historical volatility, then that's maybe a good time to actually be a buyer of the call. So if you're debating, do I want to have a credit, do a credit spread? Do I want to sell, or do I want to do a debit? So this implied volatility helps you, especially if you look at more of a short term, or if you want to do spreads, well, you want to sell, maybe do even calendars, and basically what you want to do, make sure that you pay for the lower volatility and you collect the higher volatility. So this is one of the ways to see where you stand as far as historical point of view. Now, obviously you have also, that was from TradeStation and on Thinkorswim, you also can take a look at your historical volatility, where you had been, and visually you can see, for instance, this was, you know, that's how almost like you can come up with the squeeze, right? The volatility is like really narrowed, and you can see what happened on the historical. So we are getting very close to the lows that we've been in the last 52 weeks from a year ago. So that tells us that maybe it's a good time, and you can see we are at 23. As we're expanding, we're going away, you know, the volatility is expanding. So another way through the sizzle index, you can see, all right, implied volatility is at 2447. compared to that 52 weeks high or low, you see we are very close to the bottom of it. So we can see it visually, we can use sizzle index. So we're at the 9%. Even historical one is at 16%, but we've been between 46 and 14. So you can see how close we are as far as, I'm sorry, in the 16% percentile. So that's, we are very close to that 0.14. So what again tells us that the strategy we want to be using should be more of on the debit side than on the credit side, just because of the implied volatility is low. Of course, implied volatility could go lower, but again, this is all about probabilities, right? So if, again, when we look at this, again, the earnings have come out, and of course you would think, all right, there's a retail time, there's a Christmas shopping time. But this tells us that the market makers are looking at our option market. They're looking at, we are in a low volatility environment, all right? The next lesson, I want to share this with you. This was on Wednesday. So as you know, I like Finviz. My monitors, I mostly look at, my TradeStation charts, and I look at my Thinkorswim, and sometimes I look at the Tastyworks. But once in a while, I look at the Finviz. This is open in one of the monitors, and I look at it. And this was at 12:49 East Coast time and 9:49 West Coast time. And I'm get this, you see, all right, Dow is down, we under 17 points, S&P is completely flat. And I'm looking at, wow, NASDAQ is having a really good day. So I'm watching this and I'm looking at the map and I see almost everything is red. The bright greens, this is the day after the earnings, right? So last week we talked about watch Google, and that was important. I thought it would give us a good indication for NASDAQ itself, and it didn't disappoint. So Google is bright green, Tesla is bright green, Amazon is kind of green, but not really deep, and Microsoft is bright green. Now, of course, the bigger the box, the more influence they have on indexes. So you can see these are the big boys. I mean, Apple, Microsoft, Google, Amazon. So, something was not registering. I mean, so the breadth was very narrow. So I said, I'm going to watch this. So ended up, using my other indicators. So ended up doing a shorted on the futures market. We shorted the NASDAQ. And reason for being was, and this is at the end of the day. So once you got that confirmation, you could have either gone here, or actually even this would have, let me see, we go to the low of the high, and this was the high, and then this was the basically indecision. We had the doji or the gravestones, but there was a big drop after 11 o'clock or 2 p.m. And this is what happened at the end of the day. I mean, these are all green, red. And so sometimes it's good to look at the different things. Actually, I forgot to even mention, we'll do it another class on CRTX, which was devastated. It's a dementia and Alzheimer's drug. But anyway, it's a biotech company. But anyway, just be aware of these. Sometimes the markets give you, again, being visual, they give you some guidance, and because of this. So granted, these are big, heavy duty players, but they just, at the end, they just couldn't hold the whole burden of the pressure. So another lesson I would like to share with you, maybe a lot of you use this, but I like to, again, I'm a history buff, but also sometimes I want to see, the trade I did, or what if I wanted to do it? How would that work? So TOS has something called Think Back, and we will go, again, this trade of the week will be interesting. So we will talk about, it's not a trade, it's like an anatomy of a trade. So I want to see, so we're going to talk about Amazon. So it's Friday, right? So everything is closed now, and Amazon came with its earning on Thursday. So I said, oh, you know um, what was happening before the earnings? So what was the market looking at? So once you go to analyze, again, if you're not familiar, just go to think back, and then there's a calendar here, and you can use that calendar and use any date and say, well, if I would have looked at Amazon 10 days ago, what was the expected move? What was the implied volatility? What were the prices? So let's say I had forgotten to take a screenshot or something. So this is right before the earnings, and the Amazon at that time was at 34.46. And it was nicely up, and its expected move was $134 with 80% implied volatility. If I mean, you can look at all the strikes. I mean, you can look at any. I'm just looking at the 29 October because if you're going to play earnings, you want to be the closest one, which was Fridays. So, and then you can see what is a bid and ask, and then could have looked at the implied volatility and all that. So basically, I thought it's a really nice tool that you can play with. So if you missed an opportunity or you want to use it as a lesson, you say, oh man, I was going to do that, but what if I did it? What would have happened? Would I have made money if I would have done, if I sold put or sold call? And basically, I just want to share that lesson with you. The other lesson I want to, of course, Tesla has been the talk of the town. You know, who would have thought yesterday at the evening party, you know, Tesla is going to 2000, no problem. So basically, we've been talking about on the markets about the skewness. We see how much, let's say, premium is done on the put side rather than the call side. So usually skewness is that like on the SPY, on the put side, and implied volatility is higher on the put side. But I like to have a little journey with you with Tesla to see. This is after the earnings. This is what happened on Friday here at 11:14. And basically, when we look at Tesla, and let's say you say, well, should I buy this? Is there any strategy I could use? What I can tell you is I've tried to explain it in the past, but you know, the gamma squeeze, which is basically it's the retail investors versus the market makers and how they do this. And I will have a class on that next week. But what happens with the more of more uh, buying pressure from the call side actually brings more pressure on the upside. So, and that's called gamma squeeze. So what is happening here? You have to remember the price of the options also very much depend on supply and demand. And the more there's demand, the more actually the implied volatility moves because there's more people are waiting for to buy it. So I want to share this with you. This is November 19th, which is not even 3 weeks. And you see that, well, 3 weeks from yesterday, we're at 11. So somebody thinks that we are going to go over 2000, which means about 85% increase in Tesla. They're willing to pay 80 cents. And this is what I want to emphasize. The implied volatility is 99%. What is at the money right around this area? Implied volatility is 55%. So what that means is somebody's paying this whole premium is coming because of this implied volatility. But because there's just so much enthusiasm, people are willing to jump on each other's shoulder because they think, yes, Tesla is going to go there. So they don't realize, I mean, once the implied volatility moves down, then the price, even if they're close, even if the price goes up $500, they still would lose money. The reason for being is that once I buy, let's say I'm at 1125, right? So I'm looking at this, 1125 has a 56% implied volatility. So just stay with me. If Tesla moves up $300. Okay, the $300 move, it takes us to 1425, and 1425 has what? 69% implied volatility, which is 13% or 13 points, which is almost 20+% more than where we are here. The interesting thing is, and this is not with the theta, but actual implied volatility. Once we move the $300, we are going to be at the money, and this 69% is going to drop to that 56%. So although we make money in that side, but we are losing money from the collapse of the implied volatility. So the reason I share this, there are times like this that you can take advantage of when you have 99% implied volatility. It's a juicy premium. Maybe, again, Tesla is expensive. You have to have margin. These are the times that maybe you can do the vertical credit spreads. And the reason is you have to do the calculations and other things. So when I see it's like $165 expected move, right? So 165, and the difference between 1125 and 2000 is 875. 875 divided by 165, let's say it's 5.5. That means somebody's willing to pay for a 5.5 standard deviation moves, 5.5 standard over 5. So even if, as I said, even if Tesla moves 30%, 40%, 50%, it has to move that much. So if you are at the credit, so you can keep that money, because again, in two ways, because the volatility also drops as it's moving. So I just had to share that with you. I'm sorry it was a little lengthy, but you can see again, there's a lot of enthusiasm. So now we are looking, and that's what the gamma squeeze becomes. The more there's a buyer, there's a positive delta. It has to be negated with a negative delta, because if I'm the seller, I have a negative delta. If you're a buyer, you have positive, because when you're positive, that means you want to go up. So if I have the negative delta, I have to go hedge myself, which means I have to go buy Tesla shares, maybe, or even buy the S&P, but mostly, so let's say I buy the Tesla shares. So if I'm buying it, then I'm pushing the price up. So I hope that's helpful. This idea, right? So you don't have to just push on the Tesla, but we went through this with like GameStops and AMC, the meme stock. So this is what's happening. I hope that was, again, helpful. So let's talk about trade of the week. As always, I like to focus on our morning, usually like a day trading, right? So we like our gap play, and it usually, it works nicely, not all the time, but when it does, it works nicely. And our first hour is 60 minutes. So last week, we've had one gap play. Thursday was a very tiny gap play. So, but Wednesday, that was a nice gap play. It did continue. We didn't get any confirmation. And finally, we got the confirmation about 8:15 or so. And that went where? It went all the way down to the almost the high. This goes back a few days, but almost you can see the closing of the previous day, and that's where it actually ended. So that's and the high of the first hour it held. I didn't draw a line, but so that was a nice gap. It was a tiny, but the low and the high of the first hour, again, the high held, the low had been held, holding, and then we had the big drop. Then Thursday comes, and again, the low of so the gap didn't play. So we want to watch this gap. That one hasn't been filled. So the low of the hour for Thursday, it held. And what happened on Friday? We actually went touch that low of the Thursdays, and then we close the gap. We came very close to, we have the confirmation here. Sometimes I use 1 minute if you really want to be aggressive to get it. So within the 2 or 3 minutes, we had the confirmation of the gap is playable. And then we almost closed that gap, got that satisfaction, came back half a gap. We could have been done Fibonacci, and then went back and filled it completely. And then the high of the first hour became our support. Okay, so this is how you can put the story together and play that. The other thing is, looking at the correlations again, right? So I want to just again watch the charts. That this is from my workstation that I use. So I watched the gold, of course. I watched the VIX, the Dow Jones Transportation, the bonds, crude oil, Euro USD, and Aussie dollar, by the way, which Aussie dollar has been doing very well. I think it was our stock of the week, or currency of the week 3 weeks ago. It has had a very nice move from 0.72 or so. So watch that, and dollar yen. But I want to emphasize, like, look what happened to NASDAQ on Friday. So this is NASDAQ. This is the bonds. So this is where you go. You see the bonds are going up nicely. Gold is in its own world, so that just collapsed and couldn't move. But the interesting thing is, I want to look at NASDAQ and look at financials. So this is after hours, by the way, so just emphasize on this. And that's the reason you want to watch multi-asset classes and multi-sectors. And so they give you a confirmation, the story. So when I see, for instance, basically here, the VIX is dropping, and then it goes up, and I see Dow Jones, the transportation drop, and then this moves back, and then VIX drops. So that tells me, well, they're in the cahoots, they're moving correctly. S&P, as you know, finished up, so the VIX was down. Next thing is, as far as I mentioned for next week, I would, if you're gonna do any trades, I would work on the 60 minutes on S&P, or you do NASDAQ, or they're pretty good. So I used a 8-bar exponential moving average, and I also use my 20-bar moving average. And as long as they stay above this 8, that's my confirmation. So we usually give you heads up that 8 bars, you can also do it daily on exponential. They're a good guidelines for short term. So once they break down, especially if you use candlesticks, especially with reversals, they're pretty good indicators. So this is what I would use for next week. All right, this is our gold trade. Last week, this was a feast. We almost at 250%. We made probably 300%. Well, this week, I was not too enthusiastic. I was not also like very negative about gold, but the potential for the profit was not there, and I will explain why. And I think I connected with some of you. For instance, think about this area 730. That gold was at 168. I thought that's a good support area, so that would be a good time. It did go up, but it didn't hit my 25%. So I buy at the money. It came very close, but again, I put my targets. And then, as you know, the rest of the day went down. And of course, Friday, we had the gap down, completely opposite of last week. We had this nice gap up. It's beautiful when it works. And when you make money 200 or 300%, now lose money 100, still you end up profitable. But this is what happened. So first of all, I bought 5 contracts, and I was going to buy 5 more, but I didn't. And the reason was, so let me do my analysis. And as I mentioned, I look at the Ichimoku, and I had done the Fibonacci, and what we were looking at, and it happened the previous week too. We went against at the 78.2 and 78.6 actually. So the resistance, and we got rejected. And Thursday, we were opened here, as I said, 168 was making sense, but I knew there's this resistance, and also we will see in my 60 minutes. So this red candle showed us the rejection. So I was thinking, 169 for me was the objective. Now, if I'm buying when the gold is at 160 and I'm paying really 70 cents, for instance, premium for that gold, in this case, the extrinsic value is 70 cents. So for me, really, to make any money, the stock has to move to above 168.70 for me to make money, let's say on Friday. So there's still the time value, but I have to be aware of, okay, I'm thinking about 100%, I'm thinking about 50%. Is this enough room? If I think there's that 169 is a pretty good resistance. See how many times we got rejected. So that was my hesitations to go more in that. And also the trend, hasn't been that big, but that's not, but for our Friday trades, it's not that important because it's a one-day thing you want to get in and get out. But that was one of my concerns. The other thing was, this is the 60-minute, and this is Thursday, and this is what happened on Friday. My thought process was, if it would have come down here at 168, we could have had a bounce and I would have gotten here, but I bought it right around here. And basically we had that bounce, but it never hit my, as I mentioned, my 25%, the first one. So, and then we got rejected. Look, we went below the trend line, the turning line, and we went the next day, we just broke down. But the reason I did not hold my nose to go in, because we were above the cloud. So there still was a chance, but the odds were not that great as far as the profitability. So what I'm saying is, it wasn't anything that it was really bearish. So it wasn't, it was more of a less of a potential to get profits. I also use, this is for my futures, I have a strategy that I use for gold for 1 minute. And then, as you can see, I did not jump in the first minute I was looking at. And then this is the LRC I use, 100 bar. And at 6:30, we had gone way outside our 2 standard deviation. I looked at that and I said, well, this is too early if I'm going to jump in. And our strategy is based on heavy volume. And usually when you have this heavy volume with these candlestick outside this, that's usually reversal. So if I was, for my gold play, so I didn't do this, by the way, but that would have been a good short to go. And these are 1 minute charts. So, from 1812 going to 1802, that's $10, which is $1,000 because every dollar is 100. That would have been from 6:30 to 6:45, let's say even 7 o'clock, for half an hour or 45 minutes. That could have been $1,000 trade on just one contract. So that's also I look at. Now, continuing with the story, now this is the rest of the story. Then this was right around here. I think I was looking at the 168 because now we were at the lower end of the channel. But again, at the end of the day, it didn't work. And that's part of trading. So we just move on. All right, we're almost to the end. The ETF of the week, I thought with a lot of talk about real estate and where we stand, why don't we look at a real estate ETF? They're the 2 really famous ones or big ones. This is the oldest one. It started IYR in June 12, 2000. It's the BlackRock. And it has $7.09 billion on their asset under management. It is a market cap weighted index, and they do hold REITs and actually stocks. So it's rated pretty nicely. You can see it by MSCI, but the chart, it looks really interesting. It's almost, would it be double top? We shall see. With what's happening with the affordability, interest rates, with the prices of the present real estate, there's a lot to evaluate. So, but this is optionable. You see this average volume is 7 million. So it's pretty liquid. So it's a food for thought. And it's something that has done well. I mean, this year it's up 28%. So I wanted to see what are the holdings, and these are some of the companies that they hold, and then a lot of REITs, right? Then in the past, what I've done when I used to manage portfolios, I really just liked VNQ to have exposure, so more than IYR. So I thought, well, let's discuss the Vanguard. And one of the main reasons is because the expense ratio is like almost 1/3 and a half, or less than one, more than 1/3. So, and the assets are almost 6.5 times, 45 billion, and they have a larger holding. So the volume is a little less, but they also market cap, but they actually own and use real estate in the United States. So you see it's like a typical chart. So it is something that, it's a food for thought. It's looks like a double top, but it obviously has done well. It's up, as also is up 28%, and it's above all the moving averages. But if you want to get involved in real estate, I thought that would be a good one. All right, this is where I want to spend a little time. I thought that rather than talking about stock of the week or option of the week, how about rather than using my trade, I thought using one of our members that we work with, and he does have a cash account, but we did this on a simulated, just to give us freedom to work on Amazon trade. Amazon being $3,400 stock. It's not really available to a lot of people. The margin requirements that is needed to do options on them is pretty expensive. So this work. So the emphasis on this, I just want to walk you through what we were thinking to put this trade on. What was the probabilities of winning, and why did we do this? All right. So this is a trade. Again, he did it, but we looked at it together, and we were looking at, first of all, on Amazon, we went to the earnings, went to see in 8 quarters, what has been the biggest move. So we want to see after the earnings, and it looked like most of the time it was like about 1.5 standard deviation the most. Sometimes it was pretty reasonable, there wasn't a huge move, but there were times like here, like here, like here down, here up. There were times like that actual move was more than 1 standard deviation. So we want to do something that using the expected move. So we want to see how much is the expected move, and with the expected move, obviously 68%. So if I'm going to do something, is 68% comfortable for me? So that was a little risky. So what we want to look at is maybe 2 standard deviation, which makes it 95%. Even that, we thought, well, it's something with Amazon, with the requirements and all that. So we actually looked at 3 standard deviation, and we kind of compromised. 3 standards like 99%. All right. So we compromised some close to 3, about 2.5 standard deviation. Okay. So as you can see, that the implied volatilities, what had happened at as far as like when the earnings came, you see what happens to the volatility crash. And that's the reason when we want to play earnings, we really don't want to be directional buying the earnings, because it's usually 50-50. It could go up, it could go down. Apple went down, Amazon went down, but Tesla and Microsoft, they went up. So we are really, it is at the mercy of what the numbers are going to be, or the perception of the market. But we know most of the time the volatility will drop. So it's a good idea to be the seller if you can, But then it has to be a calculated seller. That again, if you have the margins and you're willing to hold that stock, go ahead and do it. If you don't, the best bet will be doing a vertical. So that was our thought. So I hope you're with me. We're looking at, first of all, the earning is coming. I love Thursday earnings. It was Amazon, it was Apple. Friday at 6:30, at 12. I mean, we have one day. So we can close it. The Keita doesn't, but we know the volatility most likely will come down. So at least our credit side, it will help us. So what we did, this was taken picture. This was done on Wednesday night. So we were discussing this Wednesday night, and we're looking at where Apple was. It was at 33.92. We're looking at the expected move is 126.33.92. So we are saying, all right, two expected move will be 252. And we were thinking about the put side of things. I really don't like to do verticals too much on the call side. The put side, I'm more comfortable. And basically, the implied volatility was higher, and it was a good premium. So we looked at the 126.93.92. So if I double that, that's 252. 252, 33.92 minus 252, that's 31.40. So that's 2 standard deviation. If you would have gone 3 standard deviation, it would have gone to 3,020 or so. So we settled on the 3,080. So we said, well, we can sell. This is Wednesday night, remember. So the markets are closed, so we cannot really put the trade in. But what we want to do, we sold at 3,080, but we want to protect ourselves, because that 3,080, just one contract, you have to have $308,000 for one, because you have to buy 100 shares. So of Amazon, if it's naked. So we decided we'd like to do a credit spread. And we looked at, again, the deltas, and we want to pay, buy something that made sense, but also spread. We want to see how much of a margin we need. So because it's $80, that's 8,000 minus the credit that we received. So, it was 8,000. I think if we would have done 5 contracts, that would have been 39,000. Again, this is a simulated account. So, you could afford to do 200,000 on this account. So basically, that was the whole idea. And the way we wanted to do it, you just go to the spread, you do the vertical, and because we are selling, you can choose any one of these. So you just, hit the bid side, and you can work on it here. So basically, this is the next stage. Sorry, let me go back here. So basically, what you could do is just arrange it, since you already made up your mind that you're going to sell the 30,000. It's hard to say that there's $3,000, $80 a stock. You want to buy 3,000 as your hedge or your protection. And on Thursday evening, we could have collected $1.16. Next day came. Now, Amazon was at 34.41. That's already moved quite a bit higher than when we were talking, and it was actually 8:53 a.m. This picture was taken right before the earnings in the afternoon. So you can see actually the expected move even moved higher. It went to 131 because the stock had moved actually. So there was a little more volatility involved. So at that moment, decided, okay, instead of 5, we will sell the 30.80 and buy the 3, but let's do just 1. So our risk is about 8,000, and the credit was about 77 limit. We put the good till canceled. That doesn't mean much because we want to get it that day. So it would have been day or good till canceled. But what happened was it negotiated, I think, got it like 72 cents or so, 70 cents. Because sometimes it's at the spreads, you can see, now this is, see there's a big spread at that time. So you want to make sure you get some liquidity. So we ended up getting on 72 cents. So this is the actual getting in. Then it's looking at it and say, oh, this is toward the afternoon. And we see our now our 3,000 put is worth $0.015, and our 3080 is worth 2.5. As you know, what happened to Amazon is it stayed within this one standard deviation. It went down like about 100. So we were well into our zone, and as far as we could have done it. So we want to close this, and all we had to do, you just do the right click, you create a closing order, and because we had a vertical, now we had sold it, so we want to buy it. And remember, Apple was, okay, at that time, Apple was down $97, by the way. So, and basically we did that. So Apple was at 33.48. We went ahead. Actually, what I suggested, we were gonna put a limit, it was 2 cents, and we just kept paying, and then we did it at the market, ended up actually buying it for 5 cents. So, and you can see the low was 32.73. So it didn't even come, it's like $200 more than that 3080. So that was the thought about just doing a vertical on the earnings and, you know, closing it the next day. So it was just an idea I thought to share with you. So I hope it was helpful. So for our squeeze, I thought, let's look at the mid cap on S&P. And I sorted them by market cap. So the biggest one in the mid cap, they're more liquid. And you can see GameStop and Restoration Hardware. A year ago this time, there's no way you would have seen a $14 billion GameStop. But anyway, here we are. So these were just some of the ideas for you. There are some still good earnings coming up this week, but not as exciting as, you know, we had. So this past week, again, we have the two big, you know, coronavirus companies are coming up, and you know, Pfizer is starting it. So we got Under Armour is coming up on Tuesday before the open. So you know, if you want to play any of these, Amgen's coming after, Zillow's, Roku's. We got Square, Moderna is coming on Thursday. So we'll see if the Pfizer and Moderna, what will be the relationship. Uber, Airbnb, it will be interesting to see. Technically, it has provided an interesting play. So Peloton, Coinbase, and of course DraftKings. So these are the things you want to watch for. These are the most volatile ones. But again, you can read them on your own. Pfizer, Roku, Moderna, Pinterest, Semiconductor will be interesting in semiconductors. DraftKings, Uber, and Coinbase, and Square. So, all right. With that in mind, again, I really appreciate your patience. Thank you so much being with us. And Sean, we can stop the recording and open up for any questions.